This is Richard Dennis. He is one of the most famous traders who made millions of dollars in the 1970s and 1980s. To be exact, when he was 22 years old, he borrowed $1,600 and turned it into $350 million. Can you believe that? Yes, you heard me correctly. $350 million. And what's even more amazing, he did all of this in only 9 years. That's unbelievable. He used a simple and unusual strategy that many other traders said bad things about. Also, William Eckhart, another very successful trader from that time, said that trading cannot be taught. It's only a natural talent you're born with. Dennis believed that anyone could learn to trade if they got the right training. To prove he was right, he started an experiment that would become legendary in trading history. He found and trained 21 men and 2 women. They came from completely different backgrounds: office workers, musicians, chess players, regular people with no trading experience. This group became known as the Turtle Traders. When the experiment ended 5 years later, his turtles had made a total profit of $175 million. Dennis's students got incredible results, proving that following rules beats natural talent every time. In fact, Dennis expected to lose on most of his trades. But when trades went right, they would keep going for weeks or even months. And that's what made the strategy really profitable. Today, several of these former turtle traders have become successful hedge fund managers like Jerry Parker, and many had already become millionaires. Now, if you're like me, you're thinking, how did he do it? Well, I decided to look for the answer to that exact question, searching the internet and books for the strategy he used to get those huge gains. And wow, did I find something really interesting. And I have to say, Richard is a total genius. I'm going to share it with you guys. So, leave me a thank you in the comments. Let's get straight to it. Before jumping directly into Richard Dennis's strategies, we need to talk about the main rules he used in the trading world. Risk a fixed percentage per trade. Cut your losses quickly. Let your profits run. Trade trends, not predictions. Richard always told his students they should risk no more than 2% of their account on each trade. This type of percentage has always changed over the years since it depends a lot on the strategy, time frame, asset, and many other things. But Dennis used this type of risk management as his foundation. The main part of his ideas was based on one important idea: cut losses as quickly as possible and let profits run. This is what separates the professionals from everyone else. Let me show you exactly how this works on a chart. Here we can find a major resistance zone where price has touched multiple times and pushed the asset downward each time it reached that zone. It fell every single time until obviously there comes a moment where the market manages to break this structure. What happens then? The trend explodes upward. This is something Dennis wanted his students to understand really clearly. That idea that wherever you enter the market, you can make money as long as you have proper risk management. Or, as he said, risk management based more on numbers and math than on other trader psychology. Let me give you a very simple example using this same structure. Imagine a beginner trader. Instead of placing this major resistance zone at this order block, this liquidity zone, whatever you want to call it, sees 2 highs and decides to place that resistance line here. Let's put it in red, so everything matches better. He waits for it to break, for example, here to enter one of his trades. Of course, he'd lose this one here, lose the next one again, and so on until there comes a moment right at this candle where this breakout candle marks the beginning of a major uptrend. If we go back to the basic ideas from Dennis that we talked about a moment ago, if we really focus on having good risk management and cutting our losses early, but letting our profits run throughout the entire trend here, we could have lost, for example, this amount, then another amount. Those are our total losses. But here, if you notice the proportion, we would have gained this big amount. What's the final result? Total gains minus total losses equals this profit. This is a very simple example, so you understand the way Dennis thought. Obviously, he didn't enter randomly all the time. He followed specific strategies and thought about certain things that we'll see next. But clearly the most important thing about his trading style and way of thinking is that we can lose small amounts many times and make up for it by winning big amounts few times. This is one of those things that if you're starting in the trading world might surprise you quite a bit. You don't need a positive win rate to be profitable. You can lose, for example, 9 trades with a 1% stop loss, and then on that one remaining trade out of 10 make 25%, and you'll have made a lot of money. Now imagine doing this style of trading consistently. Not just having a track record of 10 trades, but having 1,000, 10,000, or 1,000,000 trades. If you look at any chart, the market will always move the same way. Trend, consolidation zone, or range as we call it, reversal, or, in this case, trend continuation, then another consolidation zone, another breakout, and so on repeatedly. So it makes a lot of sense to think that if we have risk management that involves cutting those losses as quickly as possible when we catch a complete trend in just one of these trades, we'll make much more money than we lost in all the others. But what's the problem with all this? Normally, traders, or directly people, human beings have pretty poor mental ability to face this type of situation. Any person who doesn't have discipline, practice, and knowledge of the subject will get nervous or suffer a lot each time they have one of these losses, even if you tell them they're controlled losses and that they'll recover and make more money when they catch the entire trend. Dennis talked about something that many other billionaire traders today have also said. That mental part of human beings is what normally makes new traders lose the most money, even having professionals helping them, telling them to follow those methods. If they don't spend a lot of time gaining experience, they'll end up losing money for this reason. Now, let's see step by step how Richard Dennis specifically used price action to go from $1,600 to $350 million. As I mentioned before in the structure example, Dennis, by basing himself on price action or direct market movements, had to pay close attention to previous structural highs and low zones to make all his entries. So we go to the indicator section and look for highest high, lowest low. That is the highest high and lowest low that represent with this indicator those structural high and low zones that we must think about to form our strategy. First of all, we go to the settings section and set everything to 20. Which is one of the things Dennis always did. He studied periods in 20. In the style section, we'll remove the moving average. Click OK, and that's it. Since we're only going to need those high and low zones, this indicator is very simple to see and use. Basically, it continuously shows us those highs and lows, the structures that form within those price movements. For example, here we see how we have these highs. We see this interaction of the candles with this upper zone. We're in a 1-hour time frame, so quite a bit of time passes here with price in this range. Then it falls to this zone where we see that new low is marked. What happens here? That low breaks and another low forms in this structure until when? Until it breaks again down here, and so on repeatedly. Well, Dennis also used what's called the average true range, or ATR. A very simple and well-known indicator. We search for ATR, and it appears here, even the one that comes with TradingView. We click, and something like this will appear. We go to the settings section and change the length from 14 to 20 as well. In smoothing, we'll place SMA. Click OK, and we'll add something else within this same indicator. If we go to the 3 dots of the ATR, this option to add another indicator or strategy to the ATR itself will appear. We click, and the indicators window comes up again. Several will appear down here, for example, the exponential and such, but we'll use this simple one. We'll click it, and as you can see, it adds an average that will be controlling the ATR data. We also set it to 20, and here in source, we leave it on ATR. So it's giving us the data from that ATR. In the style section, you can change the colors to your liking. I'm going to leave it like this in white. And I placed 20 here as well. So this would be the ATR. And here, the moving average. There it is, 20, 20. Dennis's basic strategy was based on this. We find these previous highs, and having this indicator, we only need to place another simple moving average. But in this case, for the upper part, we edit it and place the length at 200. In this case, I'll put it in yellow a bit thicker. I'll remove this from here. And now we have our 200 period average that will show us, with a broader view, what trend we should follow. In this case, of course, price is above that average. So we should look for bullish breakouts to enter and have price continue upward while we take those profits. What Dennis said is that we should first find a structural breakout following the current trend, that is uptrend. So we have this previous high zone, this candle that breaks it upward, and then when this candle closes from exactly that closing point of that candle, we would have to place the stop loss. We see how many points the ATR average would show us here on the right. Multiply it by 2. In this case, this value times 2 would be this value. And from the close of that candle that broke the previous highs, which would be this value, we would subtract those values. That's where we should place our stop loss. Clearly, in this case, the stop loss was hit by price, losing the trade. But that's the basis of Dennis's strategy. As I explained before, a bit further ahead, we see again this candle here that breaks those previous highs again. Uptrend, we check the ATR, which is more or less around these points. Times 2 would be this value. At the candle close, it's around this. So, again, our stop loss would be around this value. Again, we fail the trade right here. This candle breaks these previous highs again. In this case, the ATR is around this, which would be about these points. This candle, for example, is around this value. So again, it would be here the stop loss, more or less around here. In this case, what happens? As you can see, price doesn't close our stop loss because in this case, this breakout has been real. And now we only have to see where we have to take profits. Dennis tells us we should let our trade run until exactly this happens here. These lows right at the low of this candle have been broken. The next candle breaks it. So, at that exact point, we would have taken profits. What's the conclusion of having traded this way? Simply looking at price action in this automatic way, without thinking about any other data. We lost here, this percent here, another time, which in total would make this percent, while here we gained this percent. We gained a total of this percent profit following this unusual strategy that so many other traders said bad things about Dennis but with which both he and his students became millionaires. As I was saying, he based himself completely on that view of price action and believing that you can make money in financial markets not by having the maximum possible knowledge, but by making better risk management come first. Even if your knowledge and strategies were simpler, Dennis also said that this type of strategy with all the averages and all the data practically at 20, he used more short and medium term, which for him were, for example, 1-hour time frames. But then for larger time frames like daily or even weekly time frames, he placed in the upper band, not the lower one, only the upper 155, so that breakouts would make more sense in broader structures, that is structures in higher time frames. If we go back to 1 hour, you can see how that upper zone changes those upper structural highs if we change from those 20 to 55. Here you can see how these highs wouldn't be considered, but we'd go directly to having to break these ones here, which would give a safer entry in larger time frames, without a doubt. Richard Dennis has been one of the trading geniuses who has made the most profit from the market in the last 100 years. Thank you all for your support and see you guys next time.